because I think a lot of people were expecting this recession. It's been coming, this so-called recession. But if you take a look at the key U.S. economic indicators like GDP, the GDP is strong growth, inflation is sharply down, trending right, full employment, and a significant number of new jobs added every month. Deeper metrics, liquidity levels, consumer spending, consumer sentiment, consumer credit, durable goods. There seems to be no major cracks in the economy at the moment. We seem to be headed into a lower interest rates and soft landing and Goldilocks scenario. Do you agree with this? Because I don't really see the impending doom on the horizon. And I'll add like another element to this question as a Bitcoiner. Isn't this the case for central banking if they pulled off this so-called soft landing? Preston, it seems like I triggered you with that.
No, I love the question, and it's a near impossible question to answer. And the reason that I'm giving you a non-answer is because it all comes down to the speed and the magnitude of how they react to this as we continue to march forward. I can tell you from looking at the inflation numbers and how you're starting to see upticks in unemployment on a chart, that the economy is struggling. Let me turn that off. Oh my gosh, Lyn's probably laughing her tail off. I can't even tell you how many discussions I've had with Lyn where that keeps popping up. Anyway, so I got distracted. So the thing that I think that makes it really hard is they could step in and they could say, hey, we're going to add 5 trillion units here, and we're going to flood the market in this way and that way. And so similar to like what we saw with Silicon Valley Bank, and you're just not going to have this big, giant, cascading impairment kind of hit the market that I think people are familiar with when they think of like 2008 crisis or what played out very briefly for COVID. And I think COVID's the perfect example to show you and everybody listening to this what they can actually do by manipulating the monetary units in the system. During COVID, we had everybody at home. Nobody was at work. We had oil at negative prices. We had people not spending money on the roads. They were holed up at their house. But yet, if you looked at what happened in the financial markets, in equities in particular, they ripped like crazy and quickly. And it's because of the sheer amount of stimulus that was dropped into the market through that. So when we look at 2024 coming along, I have no idea how they're going to respond. I think anybody telling you that they do know how they're going to respond with respect to the speed and the magnitude is just lying to themselves as to like what it is that they think they know. So I can tell you that I will say this, and I'm curious if Lyn would agree or not. Like there are massive deflationary pressures building in the global economy right now. Massive. Like once the reverse repo dries up, and like if they truly didn't do anything and they allowed cascading impairment to occur, like this thing could get really nasty. I don't think that they're going to do that, but I don't know the magnitude and the pace at which they're going to address it.
So, and before I pass it on to Lyn, you did mention the reverse repo. So it looks like the government took care of the cash crunch, but the reverse repo market has gone from levels of 2 trillion to a low of 768 billion earlier this week. Just to add to your point, Preston, pass it on to you, Lyn. Is this potentially a worrying sign in the banking system?
Basically, the reverse repo facility, the way to think of that is that basically represents excess demand for T-bills. And so what the Fed does not want is for there be so much demand for T-bills that it pushes T-bill yields below the lower end of their target short-term interest rates. And so they have this release valve where money can instead go into a reverse repo facility and get yields that are similar to T-bills. They hold it at that level to make sure that basically there's no reason for T-bills to go below the reverse repo facility rate by any significant degree. And that's part of their kind of tightening process. And when the Treasury issues a ton of T-bills, that money can come out of reverse repo and into T-bills. So reverse repo is one of those things where, in a healthy market environment, there really shouldn't even be a reverse repo facility. Right now, it's just kind of this excess pocket of liquidity that was built up during the stimulus, and now it's kind of coming back out. And so it's kind of counteracting the Fed QT. The reason it's relevant is because after it runs out, um, if the Fed continues doing quantitative tightening, that'll be start to come out of bank reserves. It'll start to kind of kind of reduce liquidity in the core banking system, and therefore increase the odds of some sort of liquidity accident. Which, if it shows up in the Treasury market, you'd probably have the Fed come in and stop QT. A similar thing happened back in 2019 with the repo rate spike. It wasn't some gigantic event for normal people. I mean, basically, it's one of those like quiet crises that most people don't know of. But if anyone who was like following macro or banking at the time was like watching this with interest, because you had kind of an interbank overnight lending rate just completely blow out, and the Federal Reserve, in addition to addressing that market, had to come in and start buying treasuries again. Because that was kind of the core problem. There was a treasury oversupply problem. And going back to the prior point of, soft landing versus hard landing, I've been using the term emerging market landing, because when you look at like recessions in emerging markets, they look pretty different than we see in developed countries. You know, um, you have an environment where you have kind of recession-like conditions, but asset prices in local currency terms are still doing okay, because the local currency is pretty running, often very large deficits, is often inflationary. Um, and so you get these weird dichotomies where it's like a hot recession, right? It's like an inflationary recession, a stagflationary recession. And so asset prices and things like that are not doing great in, dollar terms or gold terms, or things like that, but they're doing okay in local currency terms because local currency is having a problem too. And those types of recessions only come up rarely in developed countries. We had it back in the 70s. We arguably have it right now, and we had it back in like the 40s. And those are kind of the instances where this pops up. We also see there's a very big divergence between fiscal and monetary. So monetary, like, Federal Reserve, Jerome Powell, they're trying to be relatively tight. They're trying to hold rates at a high level. They're trying to reduce their balance sheet. It's largely coming out of reverse repo. On the other hand, the government, Congress, president, and all these groups, they're running very, very large fiscal deficits. And it's not even just now, it's accumulated from decades past. So a lot of it is just interest expense is completely blowing out, ironically, because the Federal Reserve is trying to tighten. And fiscal deficits, all else being equal, are stimulatory and inflationary. And so whether or not we're going towards recession, or whether or not, how the economy is going to look like this year, a lot of it is basically what industry or what sector you're in, because some sectors are already in recession. If you're in commercial real estate, you're in a recession pretty much. If you're relying on volumes of residential home sales, you're in a recession. If you're a small business that needs access to bank loans, those update pretty quickly. So higher interest rates, like lower interest rates from loans a few years ago, are getting rolled into like higher interest rates today. They don't have very long durations, so a lot of them are pressured. On the other hand, if you're not in an interest rate sensitive industry, right? If you're in travel, if you're in restaurants, if you're in profitable tech companies, you might look around and be like, what recession? This kind of past couple weeks had record numbers for flights in the United States, or flight passengers in the United States. And so, if for example, if you're a 50-year-old upper middle class investor, you might have a fixed rate mortgage on your home. You might have a large kind of amount of T-bills and money markets. Let's say you're 50 or 60, you're kind of gearing towards a lower volatility type of portfolio at that point. As the Federal Reserve increases interest rates, your interest income increases. You're getting more money from your money market accounts. You're getting more money from your T-bills, and you can actually spend more into the economy. That you're actually being stimulated by the Fed's tightening policy, because your liabilities, your house and your fixed rate mortgage, are not changing at all. The same thing's true for investment grade corporations. If you're Google right now, you have very little debt, you have tons of cash, and now your cash is yielding higher rates. So you're actually it's actually, all else being equal, improving your bottom line, which is, mildly stimulatory. And so we have this kind of weird dichotomy, which is that if you're primarily relying on short-term financing, or a lot of financing, you're probably in trouble. You're already probably in a recession, or at least your industry is. And if you're not, and if you're on the right side of deficits, if you're the military industrial complex, if you're kind of in your own, if you're on the right side of all this interest expense, then you're doing okay. And so I think that's why the economy is kind of feeling very odd to people, because it's we have a larger gap than normal between fiscal policy and monetary policy, and so that results in kind of very bifurcated economy and very bifurcated markets.